Here's a question that sounds simple but trips up most investors. You have two bonds in front of you. Bond A has a coupon rate of 8% and bond B has a coupon rate of 6%. Which one gives you a better return? Most people immediately say bond A. But what if I told you bond A is trading at 1200 in the market and bond B is trading at 850? Suddenly, the answer isn't so obvious. Because the coupon rate printed on the bond is not your return. It never was. Your actual return depends on what you paid, what you receive, and when you receive it. And the number that captures all of that in one single figure is called the yield to maturity. By the end of this episode, you'll be able to look at any bond, run the math, and know exactly what return you are getting. Let's build that from the ground up. Hey guys, I'm Adam and welcome to Big Brain Buddy. Quick question before we start. Does financial jargon make your head spin? Yield to maturity, Macaulay duration, modified duration, yield to call. If you have ever stared at one of these words and quietly thought, what does that even mean? This series is for you. The series is called Small Steps, Big Wealth. We take one financial product at a time, strip the jargon out, and build the math step by step so you actually understand it rather than just memorizing it. Today, we are going deep on bond math, current yield, yield to call, and duration. Let's build it from the ground up. Before we go deep, let's anchor the foundation from episode 2. A bond has a face value, typically 1000, which is what the issuer returns to you at maturity. It has a coupon rate, say 7%, which means it pays 70 rupees per year. And it has a maturity date, which is when you get your principal back. Here's the thing to remember. The coupon is fixed forever. 70 is 70 regardless of what happens in the market. But the price of the bond in the secondary market moves every single day. And when the price moves, your effective return, your yield, moves with it. Same bond, same cash flows, different price paid, completely different returns. There are three types of yield we are going to calculate today, each answering a slightly different question. Let's go through them one by one with real numbers each time. Current yield, the simplest yield calculation, just one line of math. The question it answers, if I buy this bond today and hold it for 1 year, what percentage return do I get from just the coupon alone? The formula, current yield is annual coupon divided by current market price times 100. For example, the bond face value is 1000, coupon rate 7%, so the annual coupon is 70. Let's say the current market price is 850. So the current yield turns out to be 8.24%. So even though this bond's coupon rate is 7%, if you buy it today at 850, you're earning 8.24% on your actual investment because you got a discount. Now flip it. Same bond, but the market price is 1150. The current yield comes up to be 6.09%. Same bond, same 70 rupee coupon. But now you're only earning 6.09% because you paid a premium. The limitation of current yield, though, is that it only looks at the coupon. It completely ignores the fact that at maturity, you'll receive 1000 rupee face value, regardless of whether you paid 850 or 1150. That gap between what you paid and what you receive at maturity is also part of your return. Current yield misses it entirely, which is why we need yield to maturity. Yield to maturity is the most important number in the bond world. It is the total annualized return you earn if you buy the bond today and hold it all the way to maturity, accounting for every coupon payment you'll receive, the face value you'll receive at maturity, the difference between what you paid and that face value, and the time value of all these cash flows. Going back to our job offer analogy, the current yield is like looking only at your monthly salary. Yield to maturity is your true total compensation, monthly salary, annual bonus, joining allowance, and the exit settlement, all rolled into one annualized figure. Here's the intuition before we get to the formula. If you paid 850 for a 1000 face value bond, you will receive 1000 at maturity. That 150 difference is a gain. It's a part of your return on top of the coupons. Yield to maturity spreads this gain across the years remaining and adds it to your coupon yield. If you paid 1150 for the same bond, you will still only receive 1000 at maturity. That 150 difference is a loss, a drag on your return. Yield to maturity subtracts the spread across the years remaining. In both the cases, yield to maturity gives you the single true annualized number that captures everything. Here's where we get properly into the math. Stay with me, we'll go step by step. The exact yield to maturity formula is technically the discount rate that makes the present value of all future cash flows equal to the current bond price. This is a polynomial equation with no clean algebraic solution. In practice, professionals use financial calculators or spreadsheets, but there is an excellent approximation formula that gets you very close and is fully hand calculable. The yield to maturity approximation formula is written below, where C is the annual coupon, F is the face value, P is the current price, and N is the years to maturity. Now let's run a completely worked example. Discounted bond. Face value 1000, coupon 7%, annual coupon 70 rupee, market price 850. Years to maturity is 5. So step 1, calculate the annual capital gain component. This turns out to be 30 per year. You're buying at 850 but receiving 1000 at maturity. That's 150 rupee profit spread across 5 years. So 30 per year in addition to the coupon. Step 2, add coupon to annual capital gain. So 70 plus 30, 100 rupees. This is your total annual income. Step 3, calculate the average investment. This turns out to be 925. Since you paid 850 but will receive 1000, your average money at work over the life of the bond is approximately 925. Step 4, divide this to get yield to maturity. This turns out to be 10.81%. Compare this to the current yield of 8.24% we calculated earlier. Yield to maturity is higher because it's capturing the additional 150 rupee gain, which the current yield ignored. Now the same bond bought at a premium, market price at 1150, everything else the same. Step 1 gives negative 30 per year this time. Step 2 gives us 40 per year. Step 3 equals 1075. Step 4 gives us 3.72%. The yield to maturity is approximately 3.72% even though the coupon rate is 7%. And the current yield was 6.09%. This is because you paid a significant premium and you will only receive 1000 back at maturity. That 150 loss drags your real return all the way down to 3.72%. Let's now build something really powerful, a full price yield table for our bond. This makes the inverse relationship between price and yield impossible to ignore. Same bond, face value 1000, 7% coupon, 5 years to maturity. As price rises from 700 to 1200, yield to maturity falls from 17.14% all the way down to 2.67%. As the price falls, yield to maturity rises every single time, without exception. This is the inverse relationship we introduced in episode 2, but now you can see exactly how dramatic it is. A bond priced at 700 versus 1200 is technically the same bond, same issuer, same coupon, same maturity. Yet one offers more than 6 times the yield of the other. Price is everything. This is why the bond traders obsess over price movements. A seemingly small price change translates into a meaningful yield shift, and yield is what drives institutional allocation decisions worth billions of rupees. Now, yield to call. Some bonds come with a special clause. The issuer has the right to call the bond back before maturity. This is called a callable bond. Why would an issuer do this? Imagine you issued bonds at 8% when the interest rates were high. Rates then fall to 5%. Now you're stuck at paying 8% when you could refinance at 5%. The call option lets you redeem those bonds early, issue new ones at lower rate, and save the difference. For investors, this creates a risk. You might not get to hold the bond as long as you planned. The yield to maturity calculation assumes you hold to maturity. But if the bond gets called early, your actual return could be different. Yield to call is calculated exactly like yield to maturity, but with two substitutions. Call price replaces face value, and years to call replaces years to maturity. Bond price 950, coupon 70 rupees, call price 1050. Years to call 3. So step 1 gives 33.33. Step 2 gives 103.33. Step 3 gives 1000. Step 4 gives 10.33%. A general rule of thumb: when a bond is trading at a premium, always check yield to call. It's often significantly lower than the yield to maturity and may be more realistic return given the issuer's incentive to call. Now, duration. We have covered how price and yield moves in opposite directions. But here's the next logical question: by how much? If the interest rates rise by 1%, does every bond fall by the same amount? No. A bond maturing in 1 year barely moves. A bond maturing in 20 years can drop dramatically. The measure that captures this sensitivity is called duration. Duration is the weighted average time in years that it takes to receive all your cash flows from a bond. It accounts for both coupon payments and the final principal repayment. Intuitively, the longer you have to wait to get your money back, the more sensitive the bond is to interest rate changes. A 1 year bond matures so quickly that rate changes barely affect it. A 20-year bond, though, has 20 years of cash flows that all need to be discounted at the new rate. So a small rate change creates a large price change. Let's calculate Macaulay duration for a simple 3-year bond. So even though this bond matures in 3 years, the effective duration is only 2.808 years because some cash flows arrive earlier as coupons. Now, modified duration equals Macaulay duration divided by 1 plus yield to maturity. So modified duration of 2.625 means that for every 1% change in interest rates, the bond's price will change by approximately 2.625% in the opposite direction. So if the rates rise by 1%, the price will drop by 2.625%. A 1000 rupee bond drops to be approximately 973.75 rupees. If the rates fall by 1%, the price will increase by 2.625% and will be approximately costing around 1026.25 rupees. Let's now read a real world bond situation the way a professional would. Let's say RBI raises interest rates by 0.5%. You hold a 10-year government bond with modified duration of 7.11. What happens to your portfolio? Price change approximately equals negative 7.11 times 0.5%. That comes to be negative 3.55%. If you held 10 lakhs of this bond, your portfolio just dropped by approximately 35,000 in the market value overnight, just from a 0.5% rate hike. Now you understand why bond fund managers obsess over duration. When rates are expected to rise, reduce the duration. Hold shorter maturity bonds, less price sensitivity, less damage. When the rates are expected to fall, increase the duration. Hold longer maturity bonds. So when the rates fall, prices rise and higher duration bonds rise the most. Maximum gain. This is called duration management, and it is the core strategy of every professional fixed income portfolio manager in the world. Yield to maturity is your true total compensation. Duration is how locked in you are. A short duration bond is a short term contract. The market can't hurt you much because you will be out soon. A long duration bond is a 20-year contract. If the market moves against you, you are exposed for a very long time. Let's put all the math from this episode in one place. Current yield, it tells you the returns from coupon alone, ignoring the maturity value. Yield to maturity approximation, this tells you the true total annualized return if held to maturity. Yield to call, same as yield to maturity, but with call price instead of face value. and years to call instead of years to maturity. This tells you the returns if issuer calls the bond before maturity. Macaulay duration. This tells you the weighted average time to receive all your cash flows. Modified duration. This tells you the percentage price change for every 1% change in the interest rates. Price sensitivity. This tells you exactly how much your bond moves when the rates move. So, to recap what we covered in this episode, current yield is the quick and dirty coupon return. Yield to maturity is the real number. It captures coupons, principal gain or loss at maturity, and the time value of all the cash flows. When a bond trades at a discount, yield to maturity is higher than the coupon, and when it trades at a premium, yield to maturity is lower. At par, they are identical. Yield to call matters for callable bonds. Always check it when buying premium priced bonds. And duration tells you how sensitive your bond is to rate changes. Higher duration means higher volatility in both directions. Next time you read a headline saying bond yields rose sharply today, you now know exactly what that means, why it happened, and how to calculate the precise impact on any bond you hold. The math isn't intimidating once you see it clearly. It's just arithmetic in service of a very precise question: what is this bond actually worth to me? Now that you understand it, see you in the next episode.